Have you ever felt lost or overwhelmed when it comes to investing your money? You're not alone. Investing can be a powerful way to build wealth, but it's not without risks. Many beginners make common mistakes that can cost them thousands of dollars in lost profits. But don't worry, in this video, we'll reveal the top 5 investing mistakes that beginners need to avoid, so you can get the most out of your investments. We'll dive deep into each mistake and provide practical tips and strategies to help you avoid them. But before we dive in today's video, here's a quick disclaimer. Please remember, I am not a financial advisor, and so nothing we talk about in this video is financial advice, but rather my personal opinion. So before doing anything, do your own research and consult with a professional financial advisor. And as always, you can find useful links to help you on your journey in the comments section below. With that over, let's get back into the video. Mistake number 1. Investing without a plan. Investing without a plan is one of the biggest mistakes beginners make. It's important to have a goal in mind before you start investing. Are you saving for retirement, a down payment on a house, or simply trying to grow your wealth? Once you have a goal, you can create a plan that aligns with your goals and helps you reach them faster. One way to create a plan is to follow the SMART method. SMART stands for specific, measurable, achievable, relevant, and time-bound. Your investment plan should be specific, with clear goals that are measurable and achievable. It should also be relevant to your long-term financial goals and time-bound with specific deadlines. For example, if you're saving for retirement, you should calculate how much you'll need to retire comfortably and how much you'll need to save each year to reach that goal. You can then create a plan that outlines how you'll invest your money to reach that goal, taking into account your risk tolerance and investment time horizon. Mistake number 2. Not diversifying your portfolio. Another mistake beginners make is not diversifying their portfolio. It's important to spread your investments across different asset classes such as stocks, bonds, and real estate. This helps you reduce risk and increase potential returns. By investing in a mix of assets, you'll be less vulnerable to market fluctuations that can negatively impact your investments. One way to diversify your portfolio is to use index funds or exchange-traded funds, ETFs. These investment vehicles offer exposure to a wide range of assets, so you don't have to worry about picking individual stocks or bonds. They also tend to have lower fees and expenses than actively managed funds, which can eat into your returns over time. In addition, you should also consider diversifying your portfolio by investing in different sectors and industries. This can help you minimize risk by spreading your investments across multiple industries, so you're not overly exposed to any single industry or company. Mistake number 3. Timing the market. Trying to time the market is another mistake that beginners often make. It's impossible to predict the market's highs and lows, so trying to time your investments can result in missed opportunities and lost gains. Instead, focus on a long-term investment strategy that will allow you to weather short-term market volatility and ultimately grow your wealth. One way to do this is to use dollar-cost averaging. This is a strategy where you invest a fixed amount of money at regular intervals, regardless of market conditions. This allows you to take advantage of market dips and buying opportunities, while also avoiding the temptation to sell during market downturns. Another way to avoid market timing is to avoid making emotional decisions based on market volatility. It's important to remain disciplined and stick to your investment plan, even when the market is volatile. Avoid the temptation to panic and sell when the market dips, and instead focus on the long-term potential of your investments. Mistake number 4. Not doing your research. Not doing your research is another mistake that can have serious consequences. Before investing in any stock, bond, or other asset, do your due diligence. Read up on the company's financial statements, growth prospects, and overall market trends. This will help you make informed investment decisions that align with your financial goals and risk tolerance. You should also be aware of any fees and expenses associated with the investment. High fees can eat into your returns and erode your profits over time, so it's important to choose investments with low fees and expenses. In addition, keep up to date on market trends and economic news that may impact your investments. This can help you make informed decisions and adjust your investment strategy as needed. Mistake number 5. Letting emotions drive your investment decisions. Finally, one of the biggest mistakes beginners make is letting emotions drive their investment decisions. It's easy to get caught up in market hype or panic during market downturns, but this can lead to impulsive decisions that can negatively impact your investments. One way to avoid emotional investing is to create an investment policy statement, IPS. An IPS outlines your investment goals, risk tolerance, and investment strategy. It also includes guidelines for when you will make investment decisions and when you will rebalance your portfolio. Having an IPS can help you remain disciplined and avoid making impulsive investment decisions based on emotions. In summary, investing can be a great way to build wealth and achieve your financial goals, but it's important to avoid common mistakes that can derail your progress. Remember to create a plan, diversify your portfolio, avoid timing the market, do your research, and keep emotions in check. By following these tips, you'll be well on your way to building a strong and successful investment portfolio. If you're not already, be sure to subscribe to our channel for more great content on wealth, personal finance, and investing. And if you've enjoyed this video, don't forget to spam the like button, as YouTube will recommend it to more people just like you. If you have any questions or comments, feel free to leave them in the comment section below. Thanks for watching.